fundsupermart.com.
The U.S. experienced some setbacks in the first quarter, but is widely expected to pick up again. With us today is Mr. Michael Memory, Vice President and Senior Product Specialist at Allianz Global Investors, who shares with us his views. What is your view on U.S. road to recovery? How has it done so far?
So U.S. economic growth has been modest, but on a relative basis, it has outperformed other developed nations. Through this recovery, we've seen strength in various parts of the economy, including the U.S. housing market, where we've seen prices continually appreciating over time. We've also seen a rebound in the manufacturing sector. And concurrent with that rebound, we've also seen an increase in consumer confidence. This sentiment is being reflected in part due to the strength in the labor markets. So consumer spending is driving 70% of the economic growth. So an important ingredient has been that consumer confidence. And again, when we think about the labor markets have improved markedly from peaking at 10% after the recession to lower than 6% today. But the missing ingredient so far has been inflation. And more recently, we've seen a weakness in the first quarter GDP numbers. Those factors that have been the driver of that weakness, the primary driver of the weakness in the first quarter, they should abate on a going forward basis. So we see strength resuming.
What is your outlook on the U.S. for the rest of 2015? Why?
So we have a constructive outlook on the U.S. economy. We've seen continued improvement in the jobs market. We've also seen construction spending, housing sales, and housing prices continue to increase. In addition to that, we've seen wages starting to firm, and the benefit of equity market strength and the housing market strength should result in a wealth effect, along with lower energy prices should help drive consumer spending on a going forward basis. With regard to Europe, we should see some firming of the economy there, which should create additional demand for U.S. goods on a going forward basis. Finally, when we think about global monetary policy, it has been very accommodative, and we've seen aggressive measures taken by Europe as well as parts of Asia. And although there's been some uncertainty around monetary policy in the U.S., should the Fed hike rates, it is a sign that the U.S. economy is strong enough to withstand it.
What is your outlook on the U.S. high-yield sector? What investment opportunities have you identified?
So we have a positive outlook on the U.S. high-yield market. Defaults had kind of moved up earlier in the year, but have since then ticked down lower, and we expect default rates to remain low for the remainder of 2015. When we look at balance sheets, when we look at credit fundamentals, all the things point to a very healthy high-yield market. Leverage levels have ticked lower, interest coverage remains near all-time highs, and cash on the balance sheet is very elevated at this time. When we think about monetary policy and some of the things surrounding the interest rate environment, there is no sign of a Treasury curve inverting anytime soon, which has been a very good predictor of spread widening. But in addition, every time we've seen a rate hike, the first rate hike of the rate hike cycles have always been good for spreads prior to the first rate hike and the periods after the first rate hike. So if we think back to 2014, U.S. high yield underperformed relative to our expectations, but this year we've been positive on it, and the high yield market has increased more than 4% through May. So we've seen a nice snapback, and on a going forward basis, we expect high yield to provide a coupon or coupon plus return for the full year 2015. Areas that we are positive on, or where we've been selective on, include industrials, healthcare, materials, and consumer.
Can you share with us your investment strategy and philosophy? How do you position yourself to capture opportunities while defending against losses?
Sure. So I'll take a moment to mention our income and growth strategy, which has seen significant demand both overseas as well as in the U.S. The strategy is designed to provide consistent income, long-term capital appreciation, as well as an asymmetric return profile, so more of the upside and less of the downside compared to equities. The strategy is comprised of high-yield bonds, convertibles, and equities with a cover call strategy, and these allocations are equally weighted. So it's not pure equity or pure fixed income, but a broad-based, diversified approach that can deliver equity-like returns with less volatility and protect you in rising interest rate environments. Finally, when you think of many of the income strategies in the marketplace today, many of them take a macro-based approach or a top-down approach where we're trying to uncover relative value among asset classes. The income and growth strategy takes a bottom-up approach where we try to uncover relative value within the capital structure. So what we want to look for is where is the best total return opportunity? Is it the equity with a covered call? Is it the convertible bond? Or is it the high yield bond?